box. The data is out, and it's up 0.4 on CPI headline. That is smack dab right in the center of expectations. Strip out food and energy, looks to be up 0.3, but maybe the most important aspect is year-over-year comparisons. We're looking at last month's 2.1 year-over-year on core X food and energy, and guess where it is? 2.1, right on top of last month's. However, it's a little higher than some thought on the expectation front, but it's still close. And keep in mind, that series peaked a year ago, February, around 2.5 year-over-year. So even though it's holding at levels that are lower than what should be the panic button. And indeed, that seemed to be the case based on the minutes yesterday. Contained inflation seemed to be kind of the thought process, along with how many more eases? Well, the market readjusted. Right now, June is definitely much closer to a 25-30% than it is to the 60% it was towards last week. We see interest rates on this data. They're moving up just a bit, but also keep in mind interest rates dropped rather nicely yesterday along with the big stock rally. Dollar under huge pressure, basically making new lows for the year in the dollar index. Back to you.
All right, Rick, thanks. Let's check the reaction at the Chicago Mercantile Exchange. Joining us is Bob Iacchino of RWH Financial. Is there anything that this number can do to change what has been keying the market, and that is these great earnings?
Well, I don't think so, Joe. I mean, you're looking at us come in up 40 or so in the S&P, and I think that's exactly what you wanted to see after a rally like yesterday. You saw the overseas market up. You saw energies tick down a little bit. We come in with a little bit of cushion, even if the CPI number, the core CPI number, came in slightly higher than expected. I think it's sort of losing its luster and its importance as a sort of economic factor that traders look at. You're looking at a situation where gold is rallying in the face of what the Fed is saying are controlled, at least for now, inflation pressures. So gold is telling us something else, possibly about the geopolitical situation. So when you look at it now, our minds are off the Fed. Fed President Yellen told us yesterday to take our minds off the Fed. Greg Ip told us to take our minds off the Fed in the Wall Street Journal. So that's what we're going to do. We're going to start looking at the relationship between the long end of the yield curve and what gold is trying to tell us in terms of where the equity market's going to go over the next couple of months here.
The market doesn't or hasn't in recent years put together two big days in a row. I mean, do you expect it to today?
I'm not going to call today a big day. I just think we have a cushion that can add to it. If you look at yesterday, what we had was, let's take the Dow. It was about 140 points up until the Fed minutes came out. Then it shot up to 200 points up. And the key to it, in the last hour and a half, it held those gains. There was no taking of profits. There was no selling off. And the reason being is that was short covering. Now traders are going to put long positions out over the next few days, even if it dips.
All right, Bob. Appreciate it.
Thank you, Joe.
Bob Iacchino of RWH Financial.
We want to check oil, but first want to check in also with our guest host, Todd Buchholz, a former White House economic advisor, about that CPI number. I heard when the number hit, it seemed a little surprised by the 0.3.
Yeah, it could have been better.
Yeah, it could have been worse, though.
Of course, it could have been worse. But remember, the Fed didn't say